Good morning. Welcome to this voting meeting of the House Finance Committee. And I realize members are still coming. The elevators are having some issues today. But I will start by having our senior committee legislative assistant, Lori Smith, call the roll.
Chairman Samuelson.
Here.
Abney. Fleming. Oh, Lord. Cepeda Freites. Gallagher. Gungauer. Harris.
Vote by designation.
Inglis. Krajewski. Rabb.
Vote by designation.
Scott.
Vote by designation.
Vincent.
Vote by designation.
Waxman. Webster.
Vote by designation.
Chairman Griner.
Here.
DeVanzo.
Vote by designation.
Fritz. Gatos.
Vote by designation.
Jones.
Vote by designation.
Kephart. Kutz.
Vote by designation.
Mako.
Vote by designation.
Rossi. Rinkavich.
Vote by designation.
Stamba.
Vote by designation.
And Stender.
Thank you. All 26 members accounted for, and I did note that there's about 6 or 7 meetings going on in the Capitol at the same time. Hence, some of our members are voting by designation. I'd like to start. We have 3 bills listed for a vote on the agenda, then a discussion about a 4th bill. I'd like to start with House Bill 1572, sponsored by Representative Gogenauer, and we did have a hearing on this bill last week. I move that we bring up House Bill 1572, and I call on our senior executive director, Mark Foreman, to give a description.
House Bill 1572 would increase the Historic Preservation Incentive Tax Credit maximum per project credit award from $500,000 up to $1.5 million.
Thank you. And as you recall, we did increase the total amount for the historic preservation tax credits last year in the budget from $5 million to $20 million, but we left the per project cap at $500,000. Most of the applicants, almost all of the applicants, are projects of $10 million or more. So members in the historic preservation community, Representative Gogenauer, have been advocating, let's increase the maximum per project cap. Not everyone will get $1.5 million, but this would allow tax credits of up to $1.5 million. Any discussion on House Bill 1572? Are there any negative votes on House Bill 1572? We'd like a roll call vote on House Bill 1572.
Chairman Samuelson.
Yes.
Abney. Cepeda Freites.
Yes.
Fleming. Gallagher. Gungauer. Harris.
Yes by designation.
Inglis. Krajewski. Rabb.
Yes.
Scott.
Yes.
Vincent.
Yes.
Waxman. Webster.
Yes.
Chairman Griner.
Yes.
DeVanzo.
Yes by designation.
Fritz. Gatos.
Yes by designation.
Jones.
Yes by designation.
Kephart. Kutz.
Yes by designation.
Mako.
Yes by designation.
Rossi. Rinkavich.
Yes by designation.
Stamba.
Yes by designation.
And Stender.
House Bill 1572 is reported from the Finance Committee by a vote of 25-1. Congratulations, Representative Gogenauer. We now move to House Bill 1575, sponsored by Representative Freeman. And we had a committee hearing on this bill last week. And I'd like to move that we bring up 1575 and call on Mark Foreman to give a description of the bill.
House Bill 1575 would provide a new tax credit program administered by the Department of Community and Economic Development to incentivize the rehabilitation of historic mills and factories.
Thank you. And I appreciate Representative Freeman being present here today and also testifying last week before this committee. This would create a new tax credit in Pennsylvania. As we've talked about, the historic preservation tax credit has been around since 2012 and was expanded last year. Representative Freeman has identified the need for an additional tax credit because we have a lot of mills and factories in towns all over Pennsylvania, because Pennsylvania has a lot of industrial heritage. And as we're looking to reuse this building, a new tax credit targeted to restoring historic mills and factories might be very beneficial in communities all across Pennsylvania. The fiscal cost of this is $15 million, and we'd use the same $1.5 million per project cap that was in the Gogenauer bill. Any discussion on House Bill 1575? Chair Greiner?
At the hearing the other day, I think this is actually a great bill because I said I actually am on a foundation that helps restore a historic mill, and I think there's a lot of benefit to this and the factories. I can see it in my own county of Lancaster and everything, but I do, and I talked to the maker of the bill. I do really like this bill, but I do think with the budget where we're at, I think I even said a difference of one session, even with last year and now where we're at now and what we're looking at. I don't know whether I feel like I'm going to have to vote no this time, but I do like the bill and I like the intent of it. But I just wanted to go on record. I suspect, I might have some of my members. I'm not asking my members to vote no. I'm just saying, why I am, and we probably are going to need a roll call vote on this.
Thank you, Chair Greiner. I appreciate your comments. I also note for the record that Representative Scott is present. Any other member comments on House Bill 1575? I'd like to ask for a roll call vote on House Bill 1575.
Chairman Samuelson,
Yes.
Abney, Sapita Freites, Fleming, Gallagher, Gungauer, Harris,
Yes designation.
Inglis, Kajewski, Rab,
Yes designation.
Scott,
Yes.
Vincant,
Yes designation.
Waxman, Webster.
Yes designation.
Chairman Greiner,
I prefer a here vote like the other one, but I'm going to vote no.
DeVanzo,
No by designation.
Fritz, Gatos,
No by designation.
Jones,
No by designation.
Kephart, Kutz,
No by designation.
Mako,
No by designation.
Rossi, Rinkavich,
No by designation.
Stamba,
No by designation.
and Stender.
House Bill 1575 is reported from the Finance Committee by a vote of 15 to 11. Congratulations, Representative Freeman. Next, I'd like to move to the next bill on the agenda, House Bill 1610, sponsored by Representative Fiedler and also the co-prime sponsor, Representative Mary Jo Daley. And I'd like to call on our senior research analyst. I'd like to call up House Bill 1610, and I'd like to call on our senior research analyst, Shannon Snell, for a description of the bill.
Thank you. House Bill 1610 would implement combined reporting for corporate net income tax filers, and it would accomplish that by requiring a business that is made up of either separate parts of a single corporation or a group of business entities under common ownership to file an annual combined report to the Department of Revenue as a unitary business. And the members who would be a part of that combined report would be determined on a water's edge basis, which basically means that only for foreign companies or foreign subsidiaries that have a significant presence within the United States Specifically, at least 20% of the subsidiary or corporation's sales must be within the United States, should have a corporate net income tax liability in Pennsylvania, and therefore be included on the report. The exception would be tax havens, which would have to be included in the combined report regardless of the percentage of sales that were in the United States. There is a new definition of tax haven in the bill to lay out several factors that determine which jurisdictions might fall under that. However, if the tax haven can prove that there's a legitimate business purpose, they would not have to be included in the combined report. Example might be a hotel business that's located in a tax haven that's also a popular tourist destination. A couple other highlights that are new in this bill from last session. There are rules for apportioning net losses as well as tax credit and tax benefits among members of the unitary group. And there is also a safe harbor provision for unitary businesses for tax years 2026 and 27. Also, I will note that this would begin with tax year 2026.
Thank you, Shannon Snell. On the topic of combined reporting, the Finance Committee did have a hearing on this on June 29th of 2023, and we also had testimony at that time from the Independent Fiscal Office. We've shared a video of that previous hearing. Planning to call this bill up for a vote today, and I know we had an abbreviated session week. There is no Wednesday session this week. So I've taken the step to invite some testimony today, some remarks on the bill before we get to the vote. And we have the two prime sponsors. We have Amy Gill from the Department of Revenue, and also we have remarks from two individuals, one invited by myself and one invited by Chair Greiner. So we will proceed with those remarks at this time. I'd like to call up Representative Elizabeth Fiedler from Philadelphia and Representative Mary Jo Daly from Montgomery County, who are the two prime sponsors of this bill. Representative Fiedler, thank you very much, and thank you for being back before our committee. Former member of our committee. Can we have you back?
Thank you, Chair Samuelson. Thank you, Chair Greiner. Thank you for having me, and thank you for calling up this bill. Good morning, everyone. I'm State Representative Elizabeth Fiedler, and I'm here to talk briefly about HB 1610 combined reporting. I do think that the last hearing we held on this topic was really, really insightful, so I would encourage folks to go back and take a look at that testimony as well. 73% of the corporations active in our state pay no corporate taxes to the Commonwealth at all. 73%. That's because highly profitable corporations use states like Delaware that have low or no corporate net income taxes to hide their profits. To many of my constituents and people across Pennsylvania, this is unfair. The companies that benefit from this loophole are some of the biggest and richest corporations. Think insurance companies, cable companies, pharmaceutical companies. The list goes on. They use Pennsylvania's workforce and our infrastructure that we pay for to make their profits. And they should be required to play by the same rules as working people in our districts. Instead, they exploit loopholes to cheat Pennsylvania out of desperately needed tax dollars. We are in the middle of budget season here in Harrisburg and talking about the important dollars we need to fund things like schools, housing, parks, libraries, and childcare. Combined reporting puts an end to this deceptive practice by requiring that all companies operating in our state report to our state. It's simple. If a national company sells 25% of its goods or services in Pennsylvania, it should pay Pennsylvania taxes on that 25%. If this sounds like common sense to you, you're not alone. Combined reporting is already used by 28 states and the District of Columbia. When multi-state corporations pay their fair share, that means working people also get to pay their fair share. Right now, many multi-state corporations are not paying what they should be, and that means a greater tax burden falls on our constituents. That is not right. I'm hoping we can finally pass combined reporting, make it the law of the land in Pennsylvania, and do justice for our constituents. HB 1610 will generate tax dollars we need for our communities, and it will level the playing field for smaller local businesses that we all count on. Thank you for your time, and thank you to Chair Mary Jo Daly for all her work on this issue as well.
Thank you, Chair Fiedler. And I'd like to call on Chair Mary Jo Daly from the Tourism Committee, but a former member of the Finance Committee and also previously a prime sponsor on the combined reporting legislation in previous years.
Right.
Representative Mary Jo Daly.
Well, good morning to you, Chair Samuelson and Chair Greiner, and members of the Finance Committee. As a co-prime sponsor of House Bill 1610, I fully support the adoption of combined reporting, something I've been proud to work on with my colleagues for more than a decade, including as a former member of this esteemed committee. You know, some say nothing frames a discussion like a good quote. Here's one from the Institute on Taxation and Economic Policy. Quote, "Combined reporting is generally regarded as the single most important corporate tax reform state lawmakers can contemplate. It nullifies the potential tax savings from artificially shifting income to a subsidiary by bringing that income back into the tax base." I think that clearly puts into context why now in 2025, more than half the states in the country, 28 to be exact, have already adopted combined reporting policies. Over the years, I've heard some suggest this would be difficult or confusing to switch for corporations. But, you know, the first state to adopt combined reporting, which was California, it was nearly a century ago in the early 1930s. I think it's fair to say, after almost 100 years, not a new concept. Today, the 28 states already using combined reporting represent a mixture of both red and blue. Red states like Texas, Idaho, Kansas, Kentucky, and Utah, and blue states like Illinois, Michigan, Vermont, and Oregon, even several of our neighbors like New Jersey, New York, and West Virginia. I'll finish this. It's felt like a full decade that I've been trying to help advance this policy, so I know all too well how unfortunate it is that the Commonwealth can't quite yet call itself number 29. So let's fix that starting today. I urge your support for House Bill 1610, and it's been a pleasure to work with Chair Fiedler on this topic. So thank you so much.
Thank you, Chair Mary Jo Daly and Chair Elizabeth Fiedler. I'd now like to move to Amy Gill, who's the Deputy Secretary for Tax Policy in the Pennsylvania Department of Revenue. And I'm also one of the sponsors of this bill, and we worked with the Department of Revenue on the language of this legislation. So I'd like to call on Amy Gill. Thank you for being with us today.
Oh, apologies. So combined reporting was first brought up at the Business Reform Tax Commission in 2004. So 21 years ago, the Tax Reform Commission recommended combined reporting for our state. So 21 years later, we're still talking about combined reporting. So the question might be, I would pose, is what is different now? And a lot has changed in our business climate in the last 21 years. We are currently cutting the C&IT rate. It was at a high, I think the second highest in the nation, of 999. It is now going to go down to 499 by 2031. So that is a business-friendly move that should encourage businesses to come here. We also, last session, the bill was passed to increase the NOL. The NOL is currently capped at 40% of taxable income, and now it will increase to 80%. So the state has made a lot of effort and movement towards making this more business-friendly. So the time for combined reporting to modernize our tax system is now. As was mentioned before, 28 other states use it. And it's important to note, one thing to look at is where our business activity takes place. And combined reporting does a better job of measuring that in our state. Our current reporting system is separate company. And briefly, each company files on a pro forma separate basis. Combined reporting would require the unitary group to file one return and to do unitary income. So I think it's really important to point out that things are very different than 21 years ago when combined reporting first, to my knowledge, came up in discussions. Specifically for House Bill 1610, Mark and Shannon touched on this, but there are a couple new things from previous versions. There is tax haven language. It is different now. It is not outlining certain countries, but instead defining what a tax haven is. There's language to ensure that tax credits are allocated properly among the group. Definitions were added that hadn't been there previously to make it more clear. And finally, after meeting with some stakeholders, there's language in there for broker-dealers to make sure their receipts aren't inflated. So, thank you.
Thank you to Amy Gill for being with us today, and I believe you're going to stick around for the rest of our meeting. I also want to note for the record that Representative Devanzo is here and has been here for 10 minutes. Sorry, I forgot to announce when you arrived. 12 minutes. Next, we have some remarks from Leonore Harvey, Senior Tax Counsel for the Council on State Taxation. Ms. Harvey was with us in 2023 and testified at our previous hearing, and she is here today. I appreciate Chair Greiner for offering the invitation to Leonore Harvey for joining us. Can you hear us?
Yes, I can. Can you hear me?
Yes. Please proceed.
Oh. All right. Well, good morning, Chair Samuelson, Chair Greiner, and members of the Finance Committee. My name is Lenore Heavey. I'm a senior tax counsel with the Council on State Taxation, otherwise known as COST, and we appreciate the opportunity to provide testimony in opposition to House Bill 1610. COST is a nonprofit trade association with a membership of approximately 500 corporations engaged in multi-state and multinational business. COST is not a no-tax organization. Our mission is to preserve and promote equitable and non-discriminatory taxation for multi-jurisdictional businesses. Adopting mandatory combined reporting for the corporate net income tax would make Pennsylvania's most volatile revenue source even more volatile and could potentially reduce corporate tax collections in the Commonwealth while imposing significant administrative burdens on both taxpayers and tax administrators. Proponents of mandatory combined reporting argue that this method of calculating the income earned in a jurisdiction is necessary to prevent tax avoidance by multi-state businesses. However, in 2013, the Commonwealth adopted an add-back statute that requires a corporation that has intercompany transactions with an affiliate to add back any related party expenses if the purpose of the transaction was tax avoidance. This has the effect of increasing Pennsylvania income subject to the CNIT and effectively closes the so-called Delaware loophole. Additionally, in 2022, you adopted an economic nexus approach to corporate taxation, which gives the Department of Revenue expansive authority to impose the CNIT on corporations with no physical presence in the state. This change was part of the 2022 tax package in which business agreed to this provision, as well as market-based sourcing, in exchange for the beginning of the phase down of the CNIT rate. Given the add-back statute and the economic nexus standard, both of which are, how shall I say this, ably administered by your Department of Revenue, there will not be a windfall from transitioning from the current CNIT calculation method to mandatory combined reporting. In fact, although combined reporting can capture business profits earned by other members of a unitary group that are not currently taxed in the Commonwealth, this methodology would also bring other group members' losses into Pennsylvania. Contrast this to the add-back statute, where there is no downside risk. Even though many states have implemented Water's Edge combined reporting, mandatory combined reporting does impose significant administrative burdens on businesses and revenue departments. Determining who's a member of the unitary group is not simple and straightforward. There is no federal analog, unlike consolidated reporting, because unitary is a judicial construct. There's no bright line test to determine which affiliates are members of the group, and states have adopted different standards for determining who's in the group. Ultimately, determining the scope of a unitary group is complicated, subjective, and it's a costly annual process that is not currently required in Pennsylvania. Additionally, none of the states that have adopted combined reporting have required the inclusion of a foreign company solely based on the receipt of U.S. source income or because at least 20% of its sales factors within the United States, both of which would occur under the provisions of House Bill 1610. This is not water's edge reporting. This approach, coupled with the discretionary authority to identify other nations as tax havens, would create a system that could impose double taxation for international businesses located in Pennsylvania, create disputes with treaty partners, and damage the Commonwealth's competitiveness. Transitioning from Pennsylvania's current method of determining corporate income attributable to the Commonwealth to mandatory unitary combined reporting would have an unpredictable and possibly negative effect on state revenue, impose administrative burdens on both taxpayers and the department, and be detrimental to attracting new business investment or encouraging the expansion of existing businesses. So for these reasons, we urge the committee to vote no on House Bill 1610. And again, I thank you so much for the opportunity to speak to you today.
Thank you to Lenore Heavey, and appreciate you being here today and also at our previous hearing. And I will note that Lenore Heavey has given us testimony, which is in the packets of all the members of the committee, her written testimony. Next, I'd like to call on Michael Mazeroff, an independent policy analyst who was previously with the Center for Budget and Policy Priorities. Michael Mazeroff, can you hear us online?
Yes, can you hear me okay?
Yes, please proceed.
Great, thank you. Thank you, Chairman Samuelson and Chairman Greiner. I appreciate the opportunity to be here this morning. As you just noted, I was a senior fellow at the Center on Budget and Policy Priorities for 26 years until I stepped down last year. I'm still a consultant to the Center, but I need to emphasize this morning that because there wasn't enough time for the Center to clear my testimony in advance, I'm really just speaking for myself today. My testimony in Pennsylvania on combined reporting does indeed go back to all the way to the Rendell Business Tax Reform Commission in 2004. I testified on combined reporting there, and then I testified before this committee in 2005. And I'll also say, you know, there's somewhat of a personal aspect to my interest in this issue in Pennsylvania. I grew up in suburban Pittsburgh. I went to public schools there. My parents were both Pennsylvania public school teachers. So this issue is somewhat personal for me. I want the state to continue to have enough money to pay for the good schools, good education that I got in Pennsylvania, and so that people like my parents, public teachers, school teachers, and other public servants are paid what they deserve to be paid. In the interest of time, my testimony is really just going to consist of what will probably come across as maybe some disjointed bullet points, but you know, combined reporting has been debated in Pennsylvania for a very long time, more than 20 years, and I know the committee's very familiar with it, and some of the things I was going to emphasize have already been touched on by the two sponsors. So let me just sort of jump in with my bullet points. First, a point that hasn't been made yet, but I think needs to be, is that besides the fact that it's been adopted by 28 states and the District of Columbia, it's important to remember that combined reporting has also been upheld twice by the U.S. Supreme Court as a constitutional and fair method of taxing multinational and by extension, multi-state corporations. So that's point one. Point two, as has already been noted, it's been adopted by Republican and Democratic controlled states alike. In the states that have adopted it, it is not at all a controversial policy. No Republican governor coming into office in a combined reporting state has ever sought to get rid of it. It's just routine tax policy. I'm confident that the overwhelming majority of corporations that may have been lobbying the members of this committee not to adopt combined reporting, as well as the overwhelming majority of cost members, are routinely and ungrudgingly complying with combined reporting in numerous states, if not every one of the 28 combined reporting states. I mean, national retail chains like Walmart, for example, they're complying on a combined reporting basis in every state. They have stores in every state. On the issue of revenue, most of the states that have tried to estimate how much corporate income tax revenue they would gain by adopting combined reporting have estimated in the range, I'd say, of 5 to 15%. Rhode Island is the only state that I know of that actually went back after it adopted combined reporting to do a careful estimate of how much revenue it had actually gained. And it estimated that its adoption of combined reporting boosted its overall corporate income tax collections by about 25%. But for corporations that were actually subject to combined reporting, and the majority of corporations in the state aren't going to be because they're single legal entity corporations, that for the multi-entity corporations in Rhode Island that were subject to combined reporting, their corporate income tax liability went up by more than 40%. So it's not a trivial amount of revenue. So you just heard from Cost that claim that combined reporting might lose revenue on balance. And yes, it's true, some corporations could pay less under combined reporting than they would under the current system, but that is usually a temporary phenomenon in years in which they might have losses in other states, but not in Pennsylvania. And under combined reporting, rather than having to carry those losses forward, they could immediately use them to offset Pennsylvania profits. But ask yourself if you honestly think the Cost would be lobbying so aggressively in every single state that ever considers combined reporting, if it would actually allow its members to pay less corporate income tax overall. I mean, it's simply not, I think the question answers itself. That's just simply not a credible argument. Combined reporting will raise revenue on net, no question. It's only a question of how much. Now, one of the latest arguments that Cost and other combined reporting opponents have seized on, and you heard Ms. Heavey mention it, is that adoption of combined reporting increases the volatility of state corporate income tax collections. And that claim comes from a single episode in a single state, Maryland. For 5 years, Maryland required corporations to report how much tax they would have paid under combined reporting, and then compared it with how much they actually paid under the separate entity system that Maryland and Pennsylvania use. That 5-year period coincided with the Great Recession. For the 5 years as a whole, even given the Great Recession, the data showed that corporations would have paid more tax under combined reporting, but it is true that there were a couple years in which they paid less. But the Great Recession was hardly a representative time period. It was the deepest recession since the Great Depression. There's no reason to think that this result would hold true in every state. And in any case, there was only a 10% increase in revenue volatility due to combined reporting. So I'd argue that the overall increase in revenue and the way that combined reporting creates a more level playing field for small businesses completely justifies a slight increase in volatility, even if you assumed, for the sake of argument, that's a permanent effect. You deal with volatility in your tax revenue collections by having a rainy day fund. I mean, taxes on capital gains are even more volatile, and you wouldn't stop taxing them for that reason. So that's just not a good reason to not to adopt combined reporting. One of the other arguments you heard from Cost is that you don't need combined reporting because your so-called intangible add-back rule solves all or most of the interstate profit shifting problem. The add-back, just to be clear, the add-back rule disallows deductions for royalties and interests made by a Pennsylvania corporate taxpayer to a related out-of-state corporation in a state like Delaware. But this claim is just flat out false. Leaving aside the fact that Pennsylvania has an exceptionally weak add-back rule, the fact is that corporations have devised many profit-shifting strategies that don't rely on use of intercorporate charges for royalties and interest. And so add-back rules do nothing to negate them. In the last few years, South Carolina, like Pennsylvania, a non-combined reporting state, brought a half dozen court cases to try to shut down some of these other strategies. I was hired to be an expert witness of two of them involving well-known big box retailers that undoubtedly are doing business in Pennsylvania. And I can tell you that neither of them involved royalties and interests. The companies just set up separate subsidiaries to buy inventory for the stores and charge the stores such a high markup that the stores were barely profitable in one case and actually money losing in the other. And the out-of-state arms of the company also charged for back office services, management, marketing services, which shifted even more profit out of the states. In all those cases, the South Carolina Department of Revenue was trying to establish it had ad hoc authority to require combined reporting because that was the only policy that would address the problem. The two cases I was involved in both settled, but as soon as South Carolina actually won one, Koss and other corporate lobbyists went to the legislature and successfully lobbied for a bill that puts so many restrictions on the ability of the state to use combined reporting that it will never try to do so again. So corporations and their representatives understand very well that combined reporting is, unlike ad-back rules, is really the only thing that shuts down all their interstate profit shifting schemes. So the enactment of combined reporting can make an important contribution to preserving Pennsylvania's tax base from further erosion, ensuring a level playing field, and I think its adoption after 21 years of debate is long overdue. And I thank you for the opportunity to testify this morning and be happy to answer any questions.
Thank you to Michael Mazeroff. Appreciate you being with us today, and Michael appeared at my request, but thank you for offering your testimony this morning. I'd now like to open it up to questions from members of the committee. Our testifiers are still here. Lenore Heavey, Michael Mazeroff, Amy Gill from the Department of Revenue. I know Chair Greiner and I have some remarks. Any other members of the committee? I'd like to call on Chair Greiner.
Thank you, Chairman Samuelson. It doesn't happen often as chairman of the committee that I urge a strong no on a bill. You were here earlier, and I voted no on a bill that I actually liked, just because of the troubles we have with the budget. However, I was a township supervisor, and I'm maybe being a CPA, I'm very process-driven as well. And I do feel this bill has been rushed through the process extremely quickly. One thing that I've said, and I've said Department of Revenue too, and I do want to make a clear point that I personally am not against combined reporting. But what I do believe is that the stakeholders, it's interesting that there's been a bill worked on, and the stakeholders that this affects the most directly have not been at the table. And to me, that's extremely troublesome. When you look at, I understand the fact, and I do kind of get a kick out of the red states, blue states, but the reality is everybody's been at the table to come up with a good piece of legislation in those states, which is over 50% now. And they're very technical, very difficult. It is not easy. Contrary to what some of the testimony said, this is complex. There's different methodologies. We have Water's Edge. We have the other methodology, and I just feel that the lack of stakeholder feedback, which was very quick, very fast, is troublesome. And what I have heard, it will be the most regressive combined reporting proposal in all 50 states. So we'll end up, here we are again, Pennsylvania, losing business left and right, and we have the most regressive corporate policy in the country. And then there was this, we continue to hear the claim that we need to close the Delaware loophole. Well, the Delaware loophole was closed in 2013, which, with the adoption of the add-back provision requiring companies to add back to their income any transaction that was made for tax avoidance. I was here for that, you know? And here's the other thing. Department of Revenue is enforcing this vigorously. I mean, that's my understanding. And then the other thing, and it was brought up in the one testifier or two, the bill says that it ensures that businesses pay their fair share of Pennsylvania taxes, but yet it ignores that just 3 years ago, 2022, as was mentioned, this chamber implemented market sourcing policies to ensure that companies that did business in Pennsylvania paid their fair share. And my understanding is that did increase collections by $200 million a year. So now we have 2013, we have 2022. We have a situation where we have a bill where the stakeholders are not at the table. The bill, as we said, actually is more cumbersome than the one last session. And then when you look at the analysis, I don't know if this is the goal or not. We talked about it. We're losing businesses left and right. But by the Department of Revenue's own estimates, this will increase business taxes, if you look over the next few years, $1.4 billion each year on businesses. And this is where it gets complicated for people when it's very technical. This is $1.4 billion increase despite the fact we're reducing the corporate income tax rate, which I've said all along that in order for combined reporting to even be effective or to be neutral or to be more fair, we got to drop that rate pretty quickly. So in conclusion, I look at this as just another tax hike on businesses in Pennsylvania. It's, like I said, we're losing our businesses, we're losing our population. I think we need to try to incentivize businesses to try to encourage people to come here, which will allow young people to come here and work. We got to create jobs. And because of those reasons, I really do strongly, and this doesn't happen often, I strongly urge a no vote by my colleagues on this piece of legislation. Thank you.
Thank you, Chair Greiner, for your comments. I would like to speak on the bill and urge a yes vote on House Bill 1610. As we've heard today, there is a long history of discussion of combined reporting in Pennsylvania dating back 21 years. Our very own committee had a hearing 2 years ago. The Senate had a hearing in 2020. And as you heard, there was the Tax Commission back in 2004. There are 28 states around the United States that use combined reporting, one going back to the 1930s. I believe this is an important step in tax modernization and also in encouraging all taxpayers, all corporations to pay their fair share of taxes here in Pennsylvania. You heard the prime sponsor of the bill say that if a corporation is doing 25% of its business in Pennsylvania, they should pay taxes in Pennsylvania based on that 25% of their business. They should not be able, as they are currently, to shift some of that business to another state, to pretend that that business was going on in another state to avoid Pennsylvania taxes. Our constituents would be and that goes for if you're doing half of your business in Pennsylvania, you should pay taxes based on that half of the business. If you have a fraction, 10%, there should be a report. This goes on in other states. The corporations are already keeping track of how much business they're doing in all the states. You should not be allowed to shift your profits, shift your revenues to a subsidiary, to move profits, to take royalties. There are significant tax strategies to avoid the Pennsylvania corporate net income tax. You know who cannot do that? Our constituents who pay the personal income tax. None of us who pay the personal income tax are allowed to say, well, I was on vacation for 2 weeks of the year, so I should pay 2 weeks of my... No, everybody has to pay their taxes on their full income. You know who else can't do it? Small businesses, LLCs that pay the personal income tax. They have to pay Pennsylvania taxes on their full Pennsylvania income. It's only the large C corporations, the multi-state, multinational, that are allowed to do this. I say multi-state and multinational because let me ask you to think about a Pennsylvania company, a Pennsylvania corporation that does all of their business in Pennsylvania. They only do business in Pennsylvania. They are not allowed to shift their profits to another state because they're 100% in Pennsylvania. So the fairness aspect that we're talking about is making sure that the multi-state, the multinational corporations who might have the resources to invest in various tax planning, tax strategies, apportion their income so that they're paying tax on what part of the business they're doing in Pennsylvania. I do want to comment, it was just described as a tax increase. There is an estimate in the Department of Revenue on the fiscal impact, but let's talk about what we've been doing in the last few years for corporate tax policy. We voted in 2022 to cut the corporate net income tax in half over 9 years. It was 9.99%, and over 9 years, it's currently 7.99%. By January, if this bill would pass and become law, guess what? In January, it's going down another 0.5% to 7.49%. And we're on a path to get down to 4.99 by 2031. That was a significant corporate tax cut that was advanced by the Wolf administration and has been supported by the Shapiro administration and has been supported by this legislature. We also allow corporations to take tax credits. We just talked about 2 tax credits this morning involving historic preservation. All of the tax credits that we have in Pennsylvania for everything from research and development to the film industry to the historic preservation tax credit, those are still there. You can still take tax credits that are allowed by Pennsylvania law. And also, I have to note that just last year, we significantly expanded the net operating loss provisions in Pennsylvania. Up till last year, you were allowed to offset 40% of your taxable income by using previous year's losses. We changed that just last year in the budget, last July, and now we're on a path to raise that to up to 80% by the year 2028. So we've made significant steps. Now, so those are significant steps in terms of ways that we've been addressing corporate tax policy and leading to corporate tax reductions, both on corporate net income tax rate and on net operating loss provisions of our law. So I'd like to urge a yes vote on House Bill 1610 to bring fairness to our tax system, to make sure that that we do not allow tax avoidance, tax shifting. If you're doing business in Pennsylvania on a portion of your overall business, you should pay taxes on that portion of what your overall business is. So I respectfully ask for a yes vote on House Bill 1610. I'd like to call on Chair Greiner.
I don't know that we need a roll call vote. All Republicans will be no. Right? It's up to you. Unless I'm telling you all Republicans are going to be no.
Okay. Let's do a roll call vote. I know the Appropriations Committee has a shorthand way of taking the votes. Let's take the vote. I'd like to call on our senior. Any other comments? I'd like to call on our senior committee legislative assistant, Lori Smith, to call the roll on House Bill 1610.
Chairman Samuelson,
Yes.
Abney,
Yes by designation.
Sapita Freites, Fleming,
Yes by designation.
Gallagher,
Yes by designation.
Gungauer, Harris,
Yes by designation.
Inglis, Krajewski,
Yes by designation.
Rabb,
Yes by designation.
Scott,
Yes by designation.
Vincent,
Yes by designation.
Waxman, Webster. Chairman Greiner,
No.
DeVanzo, Fritz, Gatos,
No by designation.
Jones,
No by designation.
Kephart, Kutz,
No by designation.
Mako,
No by designation.
Rossi, Rinkavich,
No by designation.
Stamba,
No by designation.
Stender.
Thank you. House Bill 1610 is reported from the Finance Committee as committed by a vote of 14 to 12. Now I'd like to move into the next part of our meeting. We have a bill that has been introduced and referred to the Finance Committee. I'd like to allow some discussion on a proposal by Representative Paul Friel to allow a net operating loss exchange for corporations in Pennsylvania. And we have Representative Friel with us in person, former member of this committee. And also we're going to have testimony from Dean Miller, from the Philadelphia Alliance on Capital and Technologies. Mr. Miller's online. Let me start with Representative Friel. We also have.
The Dean's on a tight schedule. Can we have him here first?
Let me call on Dean Miller first, who has another a scheduling issue. So let me call on Dean Miller, who was with us last year when we talked about this bill in the previous session. Mr. Miller.
Thank you, Chairman. Everybody hear me okay?
Yes. And I should note for the record that we're talking about House Bill 1129, introduced by Representative Paul Friel of Chester County, and Representative Jonathan Fritz, the co-primes. Mr. Miller.
Chairman Samuelson, Chairman Greiner, and members of the Finance Committee, my name is Dean Miller, and I am President and CEO of the Philadelphia Alliance for Capital and Technologies, referred to as PACT. PACT is the largest technology and life sciences business association in southeastern Pennsylvania, representing nearly 400 companies and thousands of employees focused on these high growth sectors. Our members span the largest of tech and life sciences firms to the smallest of startups, with all companies focusing on significant investment in R&D, research and development, to develop next generation technology. We have been serving our members for over 35 years and are proud of the growth of the technology and life sciences sectors in southeastern PA, as well as the entire Commonwealth. Thank you for the opportunity to testify today regarding House Bill 1129, introduced by Representatives Friel and Fritz, regarding the establishment of a net operating loss, NOL, transfer program in the Commonwealth. I also want to thank you and your fellow legislators for your leadership in passing the aforementioned recent reforms that eliminated the restricted 40% cap on NOL carry forwards. The phased-in increase on the NOL cap will bring Pennsylvania in line with federal policy and better position our Commonwealth for growth, particularly in the technology and life sciences sectors. The continued growth of PA's tech of the Commonwealth. According to the Center for American Entrepreneurship, most new businesses lose money in their initial years, sometimes for many years, before hopefully becoming profitable. For high growth technology and life sciences companies, such losses are due to substantial research and development investments, including salaries and other expenses that exceed earnings. For these companies, R&D salaries are the primary expense of the new company in its early years. And these high growth companies have no previous income against which to apply current operating losses. And income against which losses can eventually be deducted might not materialize for years. With the increasing NOL cap in PA, these companies will have a growing asset, but without House Bill 1129, no options to monetize that asset. Technology and life sciences entrepreneurs need capital to further develop their product, research the marketplace, hire employees, and develop and implement a strategy for identifying and targeting customers. There are limited suppliers of this early capital to help fuel innovation, particularly in Pennsylvania. This capital typically is supplied by angel investors and venture capital firms, and particularly in challenging economic times, as experienced over the past several years, this capital is in very short supply. High growth companies need to cultivate many sources of capital to continue to grow their businesses and employ more Pennsylvanians with high paying jobs. New Jersey, that's right, New Jersey has had a net operating loss transfer program for over 20 years, which has enabled New Jersey entrepreneurs to raise over $1 billion in non-dilutive capital. This capital helped to fill needs at critical times when raising capital is particularly difficult. One of New Jersey's biggest success stories is Celgene. In January 2019, Celgene announced it would be acquired by Bristol Myers Squibb for $74 billion, a deal that today is still the largest pharmaceutical company acquisition ever. Celgene benefited from New Jersey's program early in its history at times when it had few other options for capital. And as a result, the success of Celgene has been directly attributed to New Jersey's net operating loss transfer program. The success of the New Jersey program has attracted many PA companies to relocate from Pennsylvania to New Jersey to take advantage of this powerful program. It is time for Pennsylvania to give those companies a reason to stay in PA and reinvest the critical capital in R&D and talent acquisition and retention in the Commonwealth of Pennsylvania. In conclusion, Pennsylvania needs to do more to support the capital needs of its fast-growing technology, advanced manufacturing, and life sciences companies. All Pennsylvanians benefit from an increasing number of high-paying jobs in the Commonwealth. The support and passing of HB House Bill 1129 will give high-growth, R&D-centric Pennsylvania companies a much-needed program to stay and grow in PA. It will also serve as an incentive to attract companies outside of PA to move to the Commonwealth and grow their workforce in PA. In both cases, this bill will allow high-growth, high-wage companies to retain and hire more Pennsylvanians. Thank you for the opportunity to testify, and I'm happy to answer any questions.
Thank you, Mr. Miller, for joining us today and also in our previous session. I do want to note for the record, we also have testimony submitted by Brian Kennedy, Senior Vice President for Operations and Government Affairs at the Pittsburgh Technology Council, which is also supportive of this legislation. I now want to call on the dynamic duo, the two prime sponsors, Representative Friel and Representative Fritz. Mr. Miller has to leave in a moment. Does anybody have questions for Mr. Miller?
I'm actually okay to stay for questions.
Okay.
Chairman.
You're okay for another 20 minutes or so?
I am.
Thank you. I'll go with Representative Friel and Representative Fritz. Representative Paul Friel of Chester County.
Thank you, Chairman Greiner. Thank you, Chairman Samuelson, for the bringing up this bill again. And I know we had a pretty robust hearing in last session and talking about this. And I don't want to repeat what Dean said because I think he articulated very well the case for what the actual mechanics of the net operating loss bill do as a non-dilutive way to raise capital early in a company's stage business. But I want to point out the broader ecosystem of small businesses in Pennsylvania that start here, and a lot of this, especially with technology and life sciences, a lot of the technology and the IP that comes out of our universities. You have Pitt and Carnegie Mellon and Penn State, who are creating, they're tier one research universities that are bringing technologies to bear. And unfortunately, some of these technologies, as they are spun out and commercialized, are leaving the state of Pennsylvania. And they're going to places like Massachusetts and California because they have a more mature capital market to fund those companies and those startups. So those jobs that are high-paying technical jobs and those businesses as they're growing, unfortunately, are growing in another state, even though the intellectual property might have originated here in Pennsylvania. And that's what I hope with this legislation. It's a small piece to start building an ecosystem that's attractive to capital. Because in addition to making the businesses themselves want to stay here, we want to attract the venture capital and the money and make a more mature capital market here in Pennsylvania and say we are in business to be in business in PA. And if we can, something like the net operating loss sale, what it does is ultimately lower the cost of capital for those businesses. And as an investor and a funder, if I'm looking at that and say, hey, I can invest money in Pennsylvania, and they have a lower cost of capital because they have a program like this that allows them to take advantage of this growing asset. And that's and none of this asset grows without significant investment in Pennsylvania people, right? Because that $10 million loss or $20 million loss over the life of that life science company, that loss is an investment in the wages and the research right here in Pennsylvania. And I think that's a really important ecosystem for us to build. And we have one of the strongest life sciences, strongest technology bases, but we're losing it. And we're losing it to places like Massachusetts, New York, and California. And I would like to see it stay here. So this is just one small piece of legislation that I believe is foundational to setting that ecosystem and attracting both capital and these technology businesses with these high-paying jobs to stay right here in Pennsylvania. So thank you very much for time allowed me.
Thank you, Representative Friel. Now I'll call Representative Fritz of Susquehanna and Wayne counties.
Well, thank you, Chairman Samuelson, as well, Chairman Greiner, and want to give a knuckle bump to my partner in crime here, Representative Friel. So friends, it's a real privilege to be here in front of the esteemed Finance Committee and the brilliant minds that comprise this committee. And appreciate shining a light on House Bill 1129, which by every measure is a pro-business piece of legislation. So what we all know is that we are realizing right now the dawning of a new technology era. We have advanced chips, we have AI, we have quantum computing, including quantum entanglements. That's a thing. Go ahead and search it. And alongside that, in Pennsylvania, like there's no debate here, we have incredible schools. We have brilliant minds, brilliant young talent right here in Pennsylvania. And we want to be able to provide a dynamic for those brilliant minds to stay right here in Pennsylvania. You know, too often in government, we are reactive instead of being proactive. And I feel that House Bill 1129 is a piece of legislation, it's policy that allows Pennsylvania to be proactive. We want to keep those brilliant young minds here. We want those businesses to open up shop right here in Pennsylvania. And for once, Pennsylvania, can we please be on the cutting edge in advancing and inviting new businesses and new technology? And for that, I ask for support of House Bill 1129.
Thank you. I'd like to open it up to questions from the committee, and also I know our Chair Greiner has a question. I do want to note in the bill analysis, there is a limit on a taxpayer who has losses could sell up to 5 million of those losses per taxable year, and there's also a lifetime cap. Also, the proposal would have DCED administer with the Department of Revenue the program. I think there's also a provision that you have to have at least 80%. If you're selling one of your losses to some other company, you have to get at least 80% by law to do that. But the basic concept, if I could ask, is if a company in its early stages has losses year after year, and with our net operating loss provisions in Pennsylvania, you can keep those losses on record with the Department of Revenue for 20 years. But if you go through several years and you're not able to use them, this bill would allow you to sell those to another company and thus get some, monetize those, get some funding in the early stages of a company. Is that?
That's exactly correct. It's allowing a way when companies are most needed those funding sources. And imagine you're going from that seed round to that round A or B, and you need some capital to bridge that. You know, when you need cash most, sometimes is when it's most difficult to raise it. And this is an asset that allows you to do that. You also mentioned, Chairman, the annual cap. So one of the things by putting that both the cap in place, it limits the size, the cost of this program. So at $100 million cap in the shield right now at the 7.5% that the corporate net income tax will be, it would be a $7.5 million potential liability that's moved forward in a current year versus a longer term wait until the companies can use it. The reason too on the annual cap of like $5 million per company is we wanted to make sure it wasn't oversubscribed by one company. We didn't want one company to come in there and just take all the available room in the cap. We wanted it to be spread out, and so if 10 companies apply, they each got a prorated portion of it. So it can't just be scooped up by a single entity or a single pharmaceutical. It actually would hit those startups, those smaller businesses, and that's the reasons for that.
Thank you, Representative Friel. I have a question from Chair Greiner.
I actually have a lot of questions, I think. I do have a lot of questions. How many other states are doing this? One.
New Jersey, correct?
All right, just one. I tell you, going back as a CPA, from a micro level, I don't know how this gets administered right. I mean, I think this is very complicated. I don't know. Let me ask you, if somebody has a $3 million net operating loss, Are they selling it? Do they get $3 million for it? I mean, or is there a percentage, or how does that?
They get the tax benefit of the $3 million. So it's not, they're not selling. So the $3 million translates to a tax benefit. So if I had a $3 million loss, right, I could shield $3 million
So let's
of
just say
income.
that-
So
let's
at
say the effective-
7.5% of that would be available of the $3 million, right? And that is the tax benefit that's for CL. So just to be easy numbers, if I had $10 million bucks would be
I don't want to get real
$70.
technical
Yeah.
with you, but so then on their tax return, they get rid of that poof, that
That's
loss.
gone.
That loss is gone then. Does Department of Revenue support this?
I believe it does. In the last cycle, it did.
The other thing that I do, and it was one of my biggest pet peeves the last time, is, and it gets back to the fairness in business practices here in the Commonwealth, that we're doing a carve out for one, and that wasn't really articulated, I don't think, well this morning, that it's only a carve out for one business. It's not for the rest of the businesses and other R&Ds and drugs and stuff. Maybe drugs. I don't know whether it's drugs. I don't know what. That bothers me a little bit too. First of all, I struggle. We all voted no on the Finance Committee on the Republican side voted no on this, and I think it's because of the questions at the macro level that we aren't including all businesses on this to start with, and then in the Commonwealth that have NOLs, give everybody that opportunity to sell them, and then secondly, I honestly, I'd have to sit down. It's like combined reporting, conceptually work through how this calculation works and how, I'm glad there's caps on it, but I struggle with this bill a lot. I'm letting you know, and I get why you're doing it. I mean, I get from a macro perspective, I get it, but I think when the devil's in the details, I don't know. And one state does it, New Jersey. I heard California here. I don't think we want to emulate New Jersey and California when it comes to tax law. Just making a comment. We heard California before too. I'm just letting you know. Thank you.
No, I appreciate the comments. I would say California does not have this. I think we brought up California, Massachusetts in the sense that they have mature capital markets, and we're losing these businesses to these states that have funding sources and capital markets that are more attractive than Pennsylvania. I would just say for the complexity of the math of this, it's simple, and it's whatever the corporate net income tax rate times the loss. That's the tax benefit that's available.
Is there a maximum of NOLs? What was that? You had the note there.
Yeah, the company that's selling would be a maximum of $5 million per year. The company that's buying could buy up to $100 million of losses per year, which would be
$7.5 million.
7.49% next year.
But unlimited, people could, all these businesses that have losses, all these startup businesses, we don't have a maximum.
It's $100 million.
100 million.
Right. So the cost to the state, the liability to the state would be potential at maximum would be 7.5% of that, which would be $7.5 million.
Thank you.
So it's a small dollar bill.
Thank you.
If I may add,
Representative Fritz?
kindly, please. I'm a very competitive person, and I hate losing to other states. I hate when other states, especially New Jersey. I mean, they already have the New Jersey Shore. Like, come on. I hate when other states eat our lunch, and that's what's presently occurring. Now, we realize that we rolled this out last session. It has some imperfections, but that's just the evolution of legislation in Harrisburg. Sometimes it takes a session or two or even three to iron out some of those wrinkles. And some of the groups and organizations that had issue with this legislation have all now coalesced around this legislation, this policy. In fact, I don't think that there are any organizations that have formally opposed this legislation. And that's what it's all about. It's a very competitive market when it comes to biotech and technology, and we need to be aggressive, Chairman Greiner, and that's what we're looking to do, is be aggressive and earn this industry and this technology here in Pennsylvania.
If I may offer, Chairman Greiner, Chairman Samuelson, and committee, 2 points. Number one, Pennsylvania is an importer of well over 80% of the capital that is raised by the companies that Representatives Fritz and and Friel referred to, over 80%. And that is a real statistic that attracts companies away from PA when they're in their formative years to raise capital. Having this bill and this money will help us retain more of those companies in Pennsylvania. The second point is around technology and life sciences companies, which you heard me mention multiple times. Chairman Greiner, this is not limited to just those types of companies. There is a much broader definition, including agricultural and a variety of companies. But it just so happens that those companies, including drug companies, biotech companies, have significant amounts of R&D spending, particularly on people, Pennsylvanians. And so we want them to be able to retain and employ more Pennsylvanians. And over the past couple of years, with the challenges from fundraising, a lot of those biotech drug companies based in PA have laid off countless numbers of Pennsylvanians because this bill did not exist.
Thank you. I have a question from Representative Stender.
Yeah, and it's not so much a question. I really want to appreciate Mr. Miller for coming talking about this important issue. In my district, we have a pharmaceutical manufacturer that's going to close. They're going to move out of Pennsylvania. They're taking all those jobs with them. And I just, we're in high school graduation party season, and I just ran into some people, and they're Pennsylvania born, Pennsylvania educated, and they're working in the biomedical field in New York City. And when I asked him, well, what would it take to come back to Pennsylvania, he almost laughed at me. And he said, Pennsylvania's structure for startup biomedical research companies, really the R&D that, the large Fortune 500 drug manufacturers are purchasing, he said, Pennsylvania's structure is just not even set up to really help us startups. He said, we're looking for capital. He goes, we're just not at that point in Pennsylvania. And I think that's a big loss for us because those are, as some of the universities we've already mentioned, those are the people we really need to retain in the state of Pennsylvania. As we continually learn, especially in the rural areas, as our population continues to get older and grow, we need these good family sustaining jobs to come into rural Pennsylvania, especially to help our university. So I appreciate the discussion. I think as the coming weeks, I think we can have a more robust conversation about this, but I really appreciate the conversation because, I think we're losing a lot of our college educated people here in Pennsylvania to other states because of these, small, minute issues, especially if they want to start a new business.
Any other member comments? Well, I'd like to thank Representative Friel, Representative Fritz for presenting this bill before us today. And thank you for your testimony. Appreciate you very much. Thank you to Dean Miller for being with us today.
Thank you, Chairman.
And I know we're also seeking some input from DCED under this bill. The net operating losses are on record with the Department of Revenue, but this bill proposes that DCED would operate the net operating loss exchange. So I encourage members of the committee to reach out to Chair Greiner and myself, Representative Friel, Representative Fritz, with any further input on House Bill 1129. With no further business, today's meeting of the House Finance Committee is adjourned.